Today, Bank of Canada raised its policy interest rates by 50 basis points or 0.5% to 3.75%. You might have seen or read about it on various media, but for the benefit of those from outside of Canada, let's hear Bank of Canada Governor Tiff Macklem has to say.
Today, we raised the policy interest rate by 50 basis points to 3.75%. This is the sixth consecutive increase since March, and quantitative tightening continues and is complementing increases in the policy interest rate.
And as the governor further indicates, this is not the end of the rate hike. Interest rates will continue to go higher. So, what does it mean to us, regular Joe, and as individual investor? How did the market interpret and respond to this rate hike? How should we navigate through this environment in our investment? And before I start, don't forget to click subscribe so you won't miss other videos update. And as we can see here, Bank of Canada had raised interest rates 6 times, a total of 350 basis points of 3.5% in just 8 months since March in 2022, including a very aggressive 100 basis points or 1% hike in July, then followed by a 75 basis point in September and another 50 basis point today, hoping to get inflation under control, as inflation can be very destructive to our economy in the long term. If we look at the Consumer Price Index or CPI charts in Canada, inflation fluctuates between 1 to 3% and averaged at about 2% in the past 10 years. With the quantitative easing or QE monetary policy, where governments injected so much money to support our economies during the pandemic in 2020, our economy has been overstimulated and inflation has been rising since early 2021, and it reached its peak in June this year in both Canada and the US. A look at this CPI table from the Bank of Canada, we will see that the total CPI went from 1% in January 2021 to 8.1% in June 2022. And it reaches 9% in the US. CPI in both Canada and the US have came down a little bit since then. But is our inflation really coming down? Let's have a closer look. Of all the items included in CPI, the 4 major items are shelter, transportation, food, and household expenditures, where shelter accounts for 30%, including rent, mortgage payment or interest, utilities, etc. And transportation at 17% includes gas, car payments, maintenance expense, or public transportation, etc. And food alone accounts for 16%, while other household expenses at about 15%. With gasoline prices came down significantly in the past few months, it certainly helps in reducing the CPI a bit. However, we are still experiencing very high inflation in housing and food-related expenses, as rental expenditure, mortgage, utility expenses remain high. And grocery prices actually went up 11% in September alone. Until we see prices in these 2 categories are easing off, it will take some time for the overall inflation to go back to normal rate. While Bank of Canada's inflation target is at about 2%, while the US Federal Reserve's target is at 4%, which is a long way to go from today's at 6.9% and 8.2% respectively. So, for investors in Canada, the US, and around the world, what is the implication of this Bank of Canada rate hike? How did the market interpret it and respond to it? Well, the market expected a 75 basis point increase as the base case, but it's only 50 basis points instead. In general, investors reacted positively as they interpret that as rate hikes starting to ease off. The US market also hopes that there will be a chance for the Fed to consider a similar moderate rates increase next week. Meanwhile, the bond yield has come down a little bit in the past few days, so the market has been rallying since this morning. However, the gains were mostly erased at the end of the day. Well, the TSX, Dow, and also Russell 2000 barely hang on to positive, while S&P 500 and the Nasdaq, in fact, it went negative at the end of the day. But why? Well, first, let's take a look at this chart on interest rates versus inflation rate. In order to manage modest economic growth and inflation, Bank of Canada has been maintaining an average spread between inflation and interest rate roughly between 0.5% to 1.5%, as you can see here, over time. Even with the increase today, there's still a wide spread of 3.15% between inflation rates at 6.9 and interest rates at 3.75, which means more rate hikes are certainly expected in the coming months. Second, it takes 18 months from the start of QE quantitative easing in 2020 to reach the peak inflation in June this year in Canada and August in the US. It will likely take a similar amount of time for this quantitative tightening or QT, the QT cycle, to work through our economy and to bring inflation back down to normal, most likely in late 2023 or early 2024. Well, and according to historic data, the chance for a recession following aggressive rate hikes or interest rates increase is higher than 75%. So, as investors, we should take these into our consideration. In a recent tweet, even Amazon founder Jeff Bezos suggested to batten down the hatches following a warning of recession by Goldman Sachs CEO David Solomon, as well as JP Morgan's CEO Jamie Dimon. So what should we do to weather the storm in this economy? Here are two basic but important things we should consider. One, review our personal finance, our budget, and balance sheet. Reduce our personal debts, especially credit card debt with high interest and fees. Reduce unnecessary spendings. Ensure that we have enough saving and sustainable cash flow to support our basic living in the next 6 to 12 months. 2. Find opportunities to invest. Well, there will be plenty of reshuffling in this down cycle, which will present new opportunities for us to invest for the next economic growth cycle. If we don't find a way to invest and stay ahead of inflation, at 7% inflation rate, our saving will be evaporated by 50% in just 10 years. Yes, you heard it right. And let me repeat, at 7% inflation, it means that the purchasing power of our money is being reduced by 7% per year. And the money that we save up for our, say, dream home, our bucket list, our retirement will be reduced by half or 50% in 10 years. And even further down to a quarter or 25% in another 10 years. Well, we certainly don't want to end up in that situation in our retirement. With this economic slowdown and the chance of a recession, we will likely see slower growth or even decline in sales, revenue, earnings, and cash flow in many businesses. The market entered into a bear market territory since March this year due to higher inflation and interest rates, and also higher uncertainties and risks in geopolitics and in the economy. In fact, if we look at this chart, the S&P 500 average PE ratio over time is at about 15, which means that long-term investors are willing to pay about 15 times of earning when investing in company stocks. However, the S&P 500 PE ratio went up as high as 40 at the end of 2020. The PE ratios of some of the tech company went up even higher to several hundred times, as many people were chasing the market due to the fear of missing out. And today, we can see that S&P 500 PE ratio has come way back down to roughly about 17. So, the good news is that this bear market also presenting us new opportunities to find great companies with good quality and good value, which we could not possibly find or get in the past 2 years. In fact, there are good companies with proven track records and solid financial metrics to weather the storms and continue to grow into the next upcycle. So value investors today would be very busy working to identify these companies, calculating their intrinsic value and their target price of entry, monitoring their watch list, and get ready to pull the triggers as the down cycle bottoms out. So how do we do that? Well, I will share more insights in various videos in the coming days. Again, please click subscribe and like so I can continue to share more updates with you and other viewers. Thank you.